Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco, and my partner, Hari.
Hello.
I like that little pause there, my partner, Hari. See?
Anticipation. It's important.
Suspense. All right, Let's get going. So the last episode, we talked about GameStop and their business. If you haven't listened to that one, be sure to check that out before you come to this, because it's very relevant. You must listen to the first one to understand what we're talking about here. Actually, before we do that, should we do a quick disclaimer, Hari?
Yeah. So the Value Investor TV podcast is designed to help you learn how value investing works. It is for information and entertainment purposes only. It's not for specific financial advice. We're not your financial advisors, nor do we know your specific financial situation. So please contact or consult with your financial advisor before making any investment decisions. Awesome.
All right, let's get started on this one. Guys, before we start, let me just say that this GameStop episode, last one and this one, came from one of our listeners. And I want to mention to you guys, his name is Grenville Fernandez. Sorry, I butchered your name, Grenville. But thank you guys. Thank you, Grenville, for sending this our way. And so I encourage all of you, like Grenville, to send over companies that you would want us to go over, because I think it really cultivates the community that we want to create, the value investor community online. So thank you guys for all that. So let's get started. In this episode, we're going to be talking about kind of the financials, right, Hari? In the previous episode, we talked about how, at this point in our checklist, we don't really see a lot of value in understanding more about the business. At this point in the checklist, given what we know about this company now, we are more interested in the assets, looking at their balance sheets, to see if there's anything that we could kind of parse out that would be of value to shareholders. So,
right.
You want to take it away from here?
Yeah. So, I think the important thing to understand here is that, let's first talk about, since we've kind of moved away from this as a ongoing business, to more about the balance sheet. What are the assets that the business has? So a lot of people are, and I think when Grenville emailed us, he was asking, how do you determine if this is a value trap? And so that's a good question. A value trap, for those of you who don't understand, is that it looks very cheap on paper, and because it looks cheap, you buy, but then the business continues to erode over time, and then eventually it goes bankrupt or it runs out of money, and then you lose. So a great example of that would have been Sears, that you could have seen for a very long time that it was a value trap, that the business kept declining, and there was no real path forward. When you look at GameStop, one of the things that we want to look at is, are they profitable, right? So the first thing that we want to ask ourselves is, are they still making money or are they losing? So in 2018, one of the things that was interesting about this is that in 2018 they sold Spring Mobile, which is a cell phone business, for $730 million. And when they did so, they were also able to retire about $300 million in debt, maybe a little more than that. So that allowed them to be in a much better financial situation. And it got rid of a business that was really struggling and tearing down the bottom line. So in 2018, they had $8.2 billion in revenue. And if you looked at their GAAP accounting earnings, they had a huge loss for the year, like a negative $7 per share loss. But if you read a little closer to the thing, that they're non-GAAP, so that they took a goodwill impairment, which means they wrote down the value of the goodwill on the balance sheet, And in doing so, they had to take a charge to their income, right? So this is very common for businesses to do so. And the reason that they took a goodwill impairment was the market cap of the company had significantly shrunk. And so by GAAP rules, there's, when you do this is, there's some leeway in when it can be done. But they took this write-down, which effectively is a non-cash expense. So they didn't have to spend any money to do this. It just lowered the value of the assets on the balance sheet. And so when their goodwill was written down, it went from 1.3 billion. So goodwill, again, for those of you who don't, down to 364 million. So for those of you who don't understand what goodwill is, you can listen to our episode on balance sheets from earlier. But goodwill is essentially the price that you pay over the book value for an acquired business. So if I buy a business that has $50 in equity, but I pay $100 for it, then I mark $50 into the goodwill section. And so that is an asset that is not a tangible asset. It is not something that I can sell to another business unless somebody buys the entire business from me. And so goodwill is not when we look at this, we're going to now start kind of analyzing GameStop not from a business perspective, but more from a liquidation type perspective, because that I think seems to be more appropriate here. So in 2018, they had $850 million in cash, and in 2019 that became 1.6 billion. So that was after they sold and they got some free cash flow and they paid down some debt. They have 1.6 billion in cash. And if you look at their market cap, the market cap for the entire business right now is about $750 million, 770 or something like that. So, they have more cash on hand than they do their entire market cap. So they could actually buy up their entire business just with cash on hand. So that's kind of an interesting concept, right? Is that you could buy this business for $750 million and net yourself $1.6 billion. Now, it doesn't quite work out that way because they have operating leases and they have debt. So the owner of a business would also have to account for $474 million in long-term debt that they have. And they also have operating leases that over a 5-year period total around $945 million. So what is an operating lease? It's essentially the lease for their stores and for their headquarters and things like that. So operating leases are things that you can't break. If you declare bankruptcy is kind of the only way to get out of an operating lease or pay a penalty, which is essentially the amount of money that you would to rent that store. So a lot of times companies, what they'll do is when they rent the store, they will just let the operating lease expire. And about 30% of that will expire this year. Another 5% will expire in 1 to 3 years, and 20% in 3 to 5 years. So, they don't have a ton of leases that will be 3 years out. They'll have gotten through about half of their operating lease. So they can fund all of their operating leases through cash flow, right? So through earnings. And right now they're still a profitable business. So as I was talking about the goodwill impairment, that was a non-cash expense. They are still cash flow positive. They're making about $230 million in free cash flow every year. Okay, so that was a lot. I just said a lot of things. Becco, why don't you...
Yeah, could we say a couple things there? So when you do goodwill impairment, what happens is your net income, because people like to look at net income as kind of the indicator of how the business is growing or shrinking, for that matter. When you do an impairment on the goodwill, this accounting expense that you're taking out from the asset part of the balance sheet gets also booked in the income. So your net income artificially goes down. So it goes down artificially, but the problem with that is this is an accounting net income. So to compensate for that, we have to really look at free cash flow. That's what Hari's talking about towards the end. Free cash flow is the actual cash that's coming in to our bank account. So this impairment doesn't affect free cash flow. So we need to look at free cash flow. That's one. The other side of things that Hari mentioned is the cash balance, as well as all the lease obligations that they have to fulfill. And so those were kind of the two big main points that you alluded to, Hari. Did I make sense there?
Yeah, no,
there was a lot there.
Yeah, I think what we're doing now is kind of analyzing how would you return the money here to the shareholder, right? Mm-hmm. With that much cash on hand, they can essentially, like I was saying, they can buy out their entire business through a share buyback, or pay you a dividend of $16, because they have about $16 per share per person right now, or per share. So there is a from a value investment perspective, early on in Buffett's career, what he would do is he would buy these so-called NetNets, right? These are net current assets minus total liabilities, would give you sort of how much money the business has, and if there was a significant if that was significantly more than the market price, you would kind of be able to walk away with this. So their equity is $1.3 billion, but that includes some goodwill and other things. So if you were to kind of do this net calculation, what you would see is the current assets are $3.1 billion. The long-term current liabilities is $2.1 billion, and long-term debt is $470 million. But the problem that we encounter with this is that they also have $900 million in operating leases that they won't just be able to get rid of, right? And so you don't have a net situation here where there's a significant margin of safety for you to do this, right? Their current liabilities minus their total, current assets minus total liabilities is not enough to give you enough cash if you were to do this, right? But you have a business that's still generating free cash flow, and so what I would say is liquidation is not an option here, because net doesn't really get you much in that way. But what you could do is actually do a share buyback, or pay a dividend, a significant dividend to the shareholders to give them access to that $1.6 billion in cash, right? So we're now talking about capital allocation decisions. What's going to maximize the shareholder returns, right? You can pay dividends, which they already currently do, about $1.50 or so, and they're still profitable. So they could continue to operate like this. But the question is, how long will they be able to go in this setup, right?
Let me just jump in there really quick and kind of summarize kind of high-level points that you mentioned, because I think this is a really important concept. Like Hari mentioned, Warren Buffett early in his career made all of his money using this NetNet strategy. If I could explain this NetNet strategy in a very simple way, it's like you have a used car that's $5,000. You buy it for $5,000, but in the glove compartment, you buy the used car, and you open up a glove compartment to clean out the used car or whatever, and you find $7,000 in there. $7,000 in there. So effectively, you made $2,000. The difference between 7 and 5. You made $2,000. That's what kind of NetNet is, and I think that kind of paints a good picture of what NetNet is really all about. So what we are doing here is we're stripping away the business and just looking at the numbers, just looking at their bank account effectively, and seeing if we could buy this outright. Could we make a profit? Is there $7,000 in the glove compartment is kind of the question that we're trying to answer for ourselves here.
Yeah, and so the answer is that you could, you could buy this for $750 million or so, and get $1.6 billion in the glove compartment, which is kind of nice, right? But then you have to still pay, 950 million in the operating leases, and you still have to pay for around 300 million in or 400 million in their debt. Right now, what you could do is, if you were to buy this business, in 5 years, all of essentially 80% of the leases for this business would be expire. Mm-hmm. And so what you could do is you could kind of sit on it and wait till the cash flow kind of dries up as as this goes out. Now, the problem is I can't estimate those cash flows out to 3 or 4 years because I don't know how quickly it's going to dry up, right? If we look at the free cash flow from 2016, it was 394. 2017, it was 321. 2018, it was 221 or 231. Sorry. So it's slowly declining, and I don't know how long it's going to really last, right? It may be 3 years, it may be 2 years, it may be 1 year, where you're trying to wait till these leases kind of run out. So now that we've kind of explained all of these, these various scenarios, the problem that I have with a business like this is that I see value in what they, in owning it. You could, there could be a buyout that occurs. There could be, something that kind of drives, value. The problem that I have right now is that I don't see management kind of slowly rolling this, they're going to try and take that $1.6 billion war chest and try and reinvent their business into something new. Yep. And I just don't see that as a good use of capital, right? They're exploring this esports business. They're kind of reinvigorate that with, training. Maybe it works out. Maybe there's knowledge there. The new CEO that they brought on has no knowledge of gaming, as far as I can tell. He is a, worked at Target and worked at, other retail stores. Video games are kind of a different beast. You can't sell, and that doesn't mean that he can't adapt and learn the video game business. But there are certain things where, people are going to put their ego, I can turn this around, and instead they should be thinking, how do I maximize shareholder returns? And as much as I would like to say, well, I can buy this for $750 million, and they could buy, do a share buyback. The problem is ultimately that the moat has eroded away. So the ongoing assets of the ongoing business operations are not going to be there as they are today in 3 to 5 to 7 years. And with that war chest that they have, they need to be thinking about paying the shareholders, not trying to take that money to, grow into a new business,
Yeah, I think it's a really interesting perspective that you bring forward there, Hari, because we see a lot of these growth companies that are starting, sprouting and becoming big, but we don't hear a lot of success stories of successfully closing down the business because it's not glamorous, right? It's always trying to get better, become bigger, but in the attempt to get bigger in these dying industries, people are burning away the shareholder return. They're not really thinking about shareholder return. They're thinking about, like you mentioned, egos and things like that. And when I read business literature, I don't think I've ever read an article or any sort of literature that talks about how a successful CEO successfully closed down a dying business. I think that's a hard thing to come by.
Yeah, and what I would say is that doesn't mean that there isn't potential value here that could be exploited. My fear is that the current management or new management, as they've just started a week ago or a month ago, is that they're not going to use that capital to return it to shareholders effectively. They talked about some cost-cutting measures that may have some one-time benefits. Cost savings around operational efficiencies at the headquarters office. And I just don't know how this is going to play out successfully unless what you say is, we're not going to open up any new stores. We're going to let all of the stores kind of age out on their operating leases. And then when the business ends, we just shut it down. I'll give you a great example. There was a company called... I believe it was called Egghead Software. This was in the early days of the internet. They had been operating retail stores around the city. or around the country. And when the internet came on, they realized immediately that software would be distributed online. So they basically just shut down. They just closed all their retail stores and then switched, away. I don't see forward-thinking businesses like that very often, right? Most managers are going to say, well, we have a great brand. Let's go leverage that brand into something else. And that comes down to this capital allocation. Like, how do you use this war chest that you have to maximize shareholder returns? Well, the way you do that is you pay the shareholders. You don't try and you don't go buy game companies and try and, do stuff like that. You don't go and build your own game assets. That's not going to, be valuable long term. And as much as I think esports is an interesting play on the gaming space, and it's a lot more popular, I just don't see how they can wedge themselves into this when the game companies can control, esports and the leagues like Overwatch and League of Legends and things like that. I don't know how they can wedge themselves into that when Fortnite and these other companies are backed by multi-billion-dollar businesses.
Yeah, exactly. And I think what's interesting to me is this. When the company is in the declining phase, the management is scrambling to figure out what to do, and there's hordes of consultants and investment banks that are trying to sell them this cosmetic surgery,
right?
To hey, just do a facelift and become a esports company now. There's probably hordes of these consultants out there trying to sell this new vision, but we need to be really careful of those minor, little tweaks, cosmetic tweaks, because fundamentally the business itself is not. If the fundamental business model is broken and it can't be adapted to the new age, the dynamicism that I talked about in the first episode might be the dynamicism to become something new it won't be shareholder friendly. The dynamicism to shut down it might be a better option for shareholders.
Yeah, and I will say, I'm not trying to completely throw management out. The board of directors has authorized a $300 million share buyback. At current prices, that's about 40% of the shares outstanding. So there is opportunity there for returning money to shareholders. But if they buy back 40% of the shares, you still have the problem of the earnings per share is declining very quickly, right? And that money can get turned negative in a heartbeat. So
yeah.
To me, the answer is still there's too much here that, and I don't have a lot of expertise in this kind of value, asset, where these assets are declining. What do you do in those situations? So I would be, I can see a path forward, but I don't know that necessarily management will appropriately, handle shareholder money. And this is not, this is fairly common in the way management would think. So
yeah.
You're not going to get you'd have to have an activist type of investor who'd come in and just, buy up a bunch and say, pay a dividend with that money instead. And right now I think they're controlled enough by existing board doesn't want to kind of, explore a dividend. The share buyback to me is actually less valuable, right, in a declining earnings per share market. I'd rather just pay a dividend here.
Yeah. Really interesting case study, I think. And thanks again for Grenville for sending this our way. I think this was a really interesting case study of a kind of declining industry, declining retail space, and kind of our thought process, our thought experiment on what they should do to maximize shareholder return. I think it was a good case study for us. I think that's it for us. Do you have anything else to add before we close out, Hari?
No, I just want to say thanks to everybody who send us emails. We really appreciate that you take the time to do that, and we certainly enjoy it. It also helps us, come up with new companies to talk about, like today. And we have a couple more, I think, to talk about from email requests. So, but keep them coming. we really appreciate it. We appreciate the kind words also, and the more you guys participate, I think the more everyone gets out of it. So
exactly.
So please keep it coming.
Mm-hmm. Yeah, exactly. If I could also mention this, for us, for both of us, we want to really build out this community of value investors. And one of the ways that you guys are helping us is with emails. But one other way that you could help us is by going on to Apple Podcasts and giving us a rating. I think Apple Podcast is kind of this de facto standard for a lot of the indexing algorithms. And so if we have more higher ratings, we'll be picked up by more people. So that would really help us. So we would appreciate that a lot. All right. Thank you guys for listening, and we'll see you on the next one.
Yeah. Thank you.
All right. See you guys.
Bye.